Hello, everyone, and welcome to your Glassnode video report for week 43, 2023. So we've got a bit of a breath of fresh air this week as Bitcoin has punched through the $30,000 level, which has been that mid-cycle point. That's what we've been really contesting with for about 5 or 6 months now, as far back as March, if I'm not mistaken. And we've actually put in a new yearly high up at 35,000. So a fairly spectacular move. The bulls have clearly taken charge. And what we're going to do today is really explore some of the market dynamics around this move, as well as things that really lead into it. So we're going to focus on this in terms of the overall flow of this particular session is kind of very much the way that I typically look at a significant move, whether up or down, we see a sell-off or a rally. What are the typical metrics and tools that I will go to really assess what happened and what does it mean moving forward? So we're going to touch on a few different things. We're going to start with some key on-chain and technical levels. I've mentioned in the past that quite often technical indicators like moving averages and even just horizontal price levels will often correlate with on-chain price models. And the reason for this is that it's all about psychology. We're tracking where investors have this psychological anchor, whether it's their cost basis, whether it's a resistance level, a support level, they all tend to coalesce around a similar level. And what we're going to look at is how some of those have really been broken through on this rally. We're going to look at the role of derivatives because a natural move is to look at liquidations and whether there's kind of a leverage squeeze. And certainly it is a part of the story, but not the entirety of the story. And we're obviously going to build in that view of the on-chain market because the on-chain is really describing the spot and what we're seeing in the spot market. And really looking at derivatives and the spot market together is really where we're getting a much more holistic view. And we're going to pair the MVRV and SOPR metrics because they are in fact siblings. And we're going to focus on the short-term holder cohort when we look at those particular metrics. And the last thing we'll look at is the long-term holders. Have we seen these long dormant coins start to respond? Are they taking profits? Are they adding to that supply? And just really looking at what the hodler class is doing now that we're up at 35,000. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. If you do have any questions along the way, please do make sure you stick them in the comment section below. And let's get stuck right into the analysis. Okay, so starting with our week on chain 43 dashboard, and we're going to start with our technical price models. Now, the reason why we're looking at these long-term moving averages is the same reason that we look at our on-chain price models. Lots and lots of people look at these. We see lots of people looking at things like the realized price. We see lots of people looking at the 200-day moving average. And in many ways, the reason why these models tend to work is because lots of people look at them. Lots of asset managers will look at the 200 days, a bull-bear bias line. For Bitcoin, each asset tends to have its own kind of special moving averages that just for whatever reason have a psychological significance. And what we can see here is we've got 3 long-term moving averages, the 200 week in the red. We've got the 111 day, which for whatever reason seems to have this nice correlation with Bitcoin. It just has a, whatever it is, a psychological bias that's kind of the period that the market has selected. And we also have the 200 day. So the 200 day, the 200 week, and the 111 day. And all of these are clustered around 28,000. Now, at various points during 2023, we've found support, we've found resistance, but they all concentrated in around this 28,000 level, which we did over the course of this week, break through, find support, and really get liftoff from that point onwards. So immediately we can see that we've got a rally above these key levels. So many traders who are looking at that 200-day bull-bear bias, at the very least, they're going to see this as a sign of strength. Now, obviously, that's just one indicator. We're going to build up the case, but that's really just setting the scene of where we are, that we're above some of these long-term moving averages, and that will likely catch the eye of traders and investors alike. So the first port of call when we see these large moves, people often go to the derivatives markets because that's where obviously these squeezes can happen. Now, there's been 3 really kind of events that are meaningful in terms of the some kind of like a long or a short squeeze this year. The first one we had was back here. We're about 64,000 BTC. By the way, this is futures open interest. And here I'm pricing it in BTC. And the reason why I do that in the native currency rather than USD is if someone opens a 1 BTC position, the open interest value will obviously move with the coin price. So in order to see the growth or reduction in open interest, I will often price it in the native currency just to try and look at the growth or change in the overall open interest levels. So we saw a big short squeeze to open up 2023. January saw about 64,000 BTC closed out in a very, very short period of time. So that was really the opening of 2023, was this short squeeze. The next major one we had was of a similar magnitude, about 64,000 BTC worth. It was a long squeeze as we came into this apex here in late August and sold off from 29 down to 26, which really set the floor for the range we traded in for several months after that. Now, what we've seen during this current rally is there was a 25,000, so not quite the 64,000 that kicked off this rally. We saw a reduction of about 25,000 BTC in open interest. It then climbed up again and again, and then we saw another round of about 35. So 60 all in, but across two different rallies. One that got us above 30K and the other one that got us from 30 to 35. So there's no question that we've had these kind of major squeeze events. We can obviously see this in the liquidation volumes. Here's our short squeeze back here in January, somewhere around 160 million in a very short span of time. We had about 220 during that long squeeze here in August. And we had 55 initially on the 17th of October. And then last night, which is the 23rd, we had an additional 130, if I remember correctly, or 125 million. So really very similar magnitude, albeit this one here was spread across two different events. And we can see that there was a short squeeze dominance. So the shorts actually getting squeezed out of their position really gave some of that lift off in both of those events. Now, this was another tool that we were playing around with for this newsletter. I'm trying to look at different ways to assess liquidation volumes and really looking for changes and when things, when do we see some kind of a signal coming out of this? So what we've got plotted here is the 30-day sum of liquidation volumes in longs in green and shorts in red. And you can see this white curve through the middle here is the net volume. So we're subtracting the shorts from the longs to try and look at what is the net overall, kind of the direction of where people are getting liquidated, so to speak. Now, the first thing to note is for the most part, Bitcoin trades with a long liquidation dominance. People are generally speaking getting liquidated on the long side. This is common in most markets. People tend to go long rather than shorts. Shorts are often a more bespoke trading style. But periods where we do actually get this short dominance are generally fairly short-lived. We can see here, and again, this is all in bear market territory on the left-hand side. But generally speaking, when people are getting liquidated on the short side in a bear market, it has been, in many instances, a bit of a local top, or at the very least, the point where a market pauses and pulls back. So we're getting this short dominance. It doesn't happen very often. And you can actually see the magnitude of the January short squeeze was quite significant, certainly the largest we've had in our data set history. But you can see that generally speaking, rallies start to cool off when we get this short dominance kick in. And we've actually hit that short dominance on this rally to 35K. So again, we only have a limited set of data because futures have only really been around for maybe 1.5 cycles. Certainly with the level of data we have, the 2021 onwards cycle is where we have most of our information. So this will grow over time, but just worth noting that we have moved into short dominance. And of the different events we've seen, that has often corresponded with some kind of a cooling off of the prevailing rally. Now, another interesting data point is looking at the funding rates. Funding rates generally give us a bit of a view of where the market is directionally leaning. So the orange is futures funding rate. That's basically the interest rate that people are paying for the privilege of being either long if it's positive or short if it's negative. In the blue, we have it for calendar futures, so that 3-month rolling basis, the cash and carry trade. Now, you can see that through most of 2023, we have had a long bias. The market has been paying a positive funding rate, meaning for the privilege of being long, they're paying a positive interest rate. Now, another important point is through most of 2023, the funding rates have been yielding more than US Treasury, something on the order of 5% plus, in many instances 6, 7, and even 8%, which in many ways makes sense from a rational perspective. The risk-free rate is somewhere around 4.5 to 5.5%, depending on what part of the year it's been, and therefore a riskier trade like doing a cash and carry on a futures exchange for Bitcoin is likely to yield something higher than that. Now, that sell-off we had in August, the long squeeze from 29 to 26, really saw this market cool off. Volumes really dropped. We spoke about this. There was a lot of apathy and exhaustion. The market really did cool off quite significantly. Now, during this week, we did have upticks in funding rates. So we have seen that positive kind of net long bias come back in, but it's nothing like what we've seen through most of 2023. So interestingly, even though there's no question that futures markets have played a significant role, we can actually see that the funding rates are relatively cool, and they actually cooled off in the lead up to the rally from 30 to 35. So they're a part of the equation, but this gives me a bit of an indication that, hey, it actually may not be it may be part of it, but it may not be the only driving factor. And that's where we have to really go and look at the spot market as well, because there are going to be dynamics there affecting it as well. And also, funding rates are now at like 2.5%, 3%, which is much less than US Treasury yield. So it again shows that there's been this apathy certainly over recent months at the very least. Now, somewhere where we are seeing significant speculation premium is options. Now, a big development in market structure we've seen really over the course of the last 6 to 8 months has been that open interest in options markets is now as large as futures. They're now comparable in size, not necessarily in trade volume. Futures still dominate in terms of trade volume, but that's more or less expected. But we have seen an 80% uplift in call option open interest. It has gone from 5.4% up to 9.7 billion. Sorry, 5.4 billion to 9.7 billion. So an 80% uptick over the course of this week alone in overall call option buying. So really, really significant. We're seeing a lot of speculation premium coming into the options markets, which is, again, it's one of these interesting market structure shifts. Historically, most of this would have shown up in futures funding rate, where people are essentially betting long in futures markets. We are seeing a lot of that speculative capital moving across to options, which is certainly an interesting development, and one that really puts the options markets on the map as an instrument to be paying more attention to. Okay, so let's move across to the on-chain side. So we've certainly established that the derivatives are a key part of this puzzle, but potentially not the entirety of the puzzle. So let's really look into the on-chain space and see what we can divulge from that. So we're going to start with the true market mean price. Now, this is actually a model that we developed alongside ARK Invest as part of our Cointime economics research. It really is an update to the realized price. It's what we, at the very least, believe is the most accurate cost basis model for active investors. We exclude lost coins, we exclude Satoshi, all of the early miners. It's a tool that really captures the cost basis for investors who are active in the market rather than the entire coin supply. And what we've seen is we have broken through this level convincingly. Again, this is also co-located around $28,000. So that really was a level. You can see it found resistance through most of our market so far, that kind of mid-cycle baseline. We are now firmly above it. So the average Bitcoin investor who is active in the market is now firmly back in profit. So at least from my perspective, as someone who spends a lot of time with on-chain data, to me, we are now truly above the inverted commas realized price. The general view of the realized price, the classic realized price, is the average cost basis for the market. To my eye, we are now actually above that level. So back in 2015, the realized price was certainly much more relevant because we just didn't know how many coins were lost, and it was a much younger space. Now I think we have the tools and certainly the rigor behind understanding that this is most likely the cost basis for the market, which also corresponds with the cycle floor around that 30K level. So being above it is going to be a psychological anchor for many investors. We may start to see investor sentiment shift, change, and certainly move because more and more people are now going to be in the green. Now, on the short-term holder cohort, remember that these are the investors who've been active over the last 155 days, and almost entirely they're going to be up in this recent 26 to 31,000 price range. That's where their cost bases have been, and we've covered them fairly in depth over recent months, being the primary driver of the market. Now, if you can believe it, their cost basis is also at around $28,000. So you can really start to see that breaking above that level has put a lot of people into the green. We've seen a lot of investors suddenly find their coins that they were buying and accumulating within that range move from a red into the green. And this is going to have some impact on how investors start to see the market. Generally speaking, short-term holder cost basis provides support. And you can see that we found it once, twice. We did break below. We're going to touch on this in a second. And we are now back above it. So again, psychologically, it's like breaking back above that 200-day moving average investor biases are likely to follow based on that this kind of behavior. Now, something I want to highlight here, we're going to talk about the MVRV and SOPR in a bit more detail because these two metrics are actually siblings. The MVRV ratio is the profit or loss held in the supply that is held by that cohort. So here we're looking at all the coins held by short-term holders. What is the average coin in profit or loss? Higher numbers in the green means that they're in profit. Lower numbers in red is that they're in loss. Well, SOPR is the exact same metric, but for the spent coins. So if every single short-term holder spent their coin right now in the next block, SOPR for short-term holders would equal MVRV because we're locking in the average profit across the entire supply that they hold. So SOPR is the spent sibling of the unspent MVRV. MVRV represents the supply held. SOPR represents the supply spent. So they're actually sibling metrics and they tell us a very similar story. What is the incentive for this cohort to sell, profit or loss? And what did they actually do? Take profit, take loss. So that's the way to think about these two metrics. So just coming back to MVRV for a second, one thing to note is that our bear market, look how we got down to relatively deep levels, right? These is 20% losses and 40% losses on average. We didn't even get down to 10%. We barely touched 10% losses. So this is telling us that even though we dipped down below the short-term holder cost basis, investors actually put quite a bit of support into that level. We really didn't get down to the types of drawdowns we see in bear markets. So it's telling us something about the resilience of investors who are currently in the space. They could have actually panicked and sold, and we'll look at SOPR in a second to see whether they did or not. But certainly the incentive to sell wasn't quite as grim or dire as it was during the bear. We can also see with MVRV, just a bit of a technical side, we can see that the overall profitability of the market was improving. We had this nice positive divergence. Even though FTX took us down to lower levels, the profitability of short-term holders was improving. And this is because coins were migrating lower and lower and lower and finding new buyers with a lower cost basis who were then willing to put that floor in. So this improvement is actually a positive or a bullish divergence. Even though the market was heading lower, the profitability of these investors was improving. And we can see we did have that uptick moving across here as well. So we know that the market got down. They got to about 10% unrealized losses. Did they actualize? Well, a lot of them did. A lot of people who were spending their coins actually took significant losses. In fact, they were the largest losses we'd seen, not quite of the same magnitude, but certainly the largest we'd seen in 2023, and importantly, over a sustained period of time. Short-term holders were taking losses and price was trading sideways. We did have panic, but it didn't take the market lower. So again, when we talk about the derivative side, that certainly was the emphasis on the move higher. But what we're seeing here is that the spot market actually did panic. Even though the incentive was there to take it lower, they did sell. We didn't actually get price being taken lower. So it's really telling us about that support level. And the coins that changed hands during this zone, it's telling us that that foundation may well have been poured in the spot market, and then the futures markets and the options market is really what pushed us through to the next level. So it's kind of that tit for tat, where you get the spot market plays its role, and then the futures and derivatives market plays the second role on the rally higher. So what we're now going to do is combine those two concepts, the MVRV, the cost basis of held supply, and SOPR, the spent basis. What was the price where the spent coins came from, for want of a better term? So what we can see is that during these bull market peaks, the green, which is the spent cost basis, is much higher than the held cost basis for short-term holders. People are taking profits above the people who are still hanging on. This shows that people are willing to take profits at higher and higher levels, and there's a degree of confidence. This red indicator here is trying to measure the direction and magnitude of short-term holder confidence. Now, what we can see is we started to get a bit of a deterioration as we first bounced our head above that 31,000 level back here in April. We started to see a deterioration in confidence. We got an initial bounce, but not to the same magnitude. Confidence continued to deteriorate. Now, we did have, and we actually covered this a couple of weeks back, I think the video was called Investor Confidence Slides. We did have weak confidence in the short-term holders, but it started to improve and we're actually getting a positive crossover as we speak. So what that's telling us is that overall, the short-term holder profitability position on both their held supply and the profits that they're taking is actually starting to improve. So overall, we are seeing a positive uptick. We are at neutral, so we do have to see if it can stick the landing, but it's really showing you how we compare that MVRV and SOPR, really looking at the spent and the unspent. That concept overall is really, really powerful, and particularly for the short-term holders, because they are that hot ball of money that is following the price around on any particular week or day. So the last topic we're going to touch on is looking at the long-term holders. And really, the story hasn't changed that much. We've been talking about how they're pretty much hanging on to their coins, and quite frankly, nothing has changed from that perspective. We've seen the supply and profit. This is actually an important tool here. The percent of supply and profit really tells us when we get these big price moves, how many coins have a cost base, those kind of supply clusters, let's call them. And we have rallied from, I think from memory, it was 60% of the supply and profit up to 81. So a fairly substantial jump. So between that 26,000 all the way up to 35, there is something on the order of about 24% of the supply has a cost basis in that zone. And in the green here, we've got our all-time average for this metric, and then we've got a plus or minus 1 standard deviation, just to really spot where we are in the cycle. We have now broken above that cycle midpoint. So we are into positive territory now. We've spent most of 2023 oscillating between the all-time average and the minus 1 standard deviation. So this is actually really, it's our first, second, third incursion into positive territory. But the question is, are we really going to stick the landing at this point in time? And you can see 2019 really kind of oscillated quite heavily between the two. We can see that back in 2015, we had a very similar mechanic where we kind of poked around in this negative territory before we finally got up into positive territory, and then the bull market really started. So we've got examples from both different events, but it shows us that we are now into that positive territory. The market is on net, back in profit. That was also confirmed by that Cointime true market mean price. Overall, the market is in a substantially better position than it was just 2, 3, 4 weeks ago. So that's overall interesting to see. Long-term holder supply continues to push to new all-time highs. Interestingly, about 30% of long-term holder supply is actually held at a loss. It's actually fairly sustained. You can see that during previous recovery phases, 2019 and 2015, the amount of long-term holder supply in a loss decayed pretty quickly. We've actually maintained this for some time. So it's telling us about that long-term holder cohort. They are continuing to accumulate, continuing to hold onto their coins, even though a lot of them in loss. They just seem to be a pretty hardened and grizzled cohort this cycle around. So it's really telling us something about their overall conviction. They're really not doing a great deal. They're just sitting and holding, which is kind of interesting to see. And the last one is revived supply. So this is looking at coins older than 1 year that are coming back into the fold. Now, what I've applied here is a Z-score. I like to use Z-scores when we're looking at things like transaction volumes or anything where I'm looking for a statistically meaningful value. Now, in this instance, I'm using a 2-year Z-score. Why do I use 2 years? Well, historically, Bitcoin moves in 4-year cycles. If I did a 4-year Z-score, I'm going to be comparing the amount of old coins being spent to both a bull and a bear. But really, what I care about at this point in time, I'm looking for inflection points. I want to see when a bear market becomes a bull market, or vice versa, when a bull market becomes a bear market. So I want to see when coins being spent in a bull at the late stage of a bull, as we can see here, is compared to the previous 2 years, which was most likely going to be a bear market. I'm looking for those deviations between cycles. So we can see that typically speaking, we get statistically massive, statistically meaningful positive spending by old coins at capitulation events, the 2018 low, the FTX low, and bull market peaks, which we saw here in 2021 in January, but also right before our sell-off from 29 to 26. A lot of old coins actually came back into the fold right before that sell-off. It's telling us there's a bunch of coins that came onto the market for whatever reason, taking profits, panicking, whatever it was, and that I mean, maybe it wasn't the driving factor, but it certainly didn't help by adding that extra supply to the market. Now, where do we sit at the moment? Well, we've been in negative territory, meaning if coins are negative on this particular metric, means that they're not being spent. There's a very small amount of spending going on. They're very dormant. And really, we are still well within that negative territory. So long-term holders, their supply is at all-time high, and they're just simply not spending. Their confidence is pretty unshaken. So more or less, we can probably continue to track the short-term holders until some of these metrics change in some other direction. So thanks as always for joining in for that session, folks. Hopefully you found that useful. Certainly spend a bit of time going over the MVRV and SOPR. That sibling pair is actually really, really powerful. We obviously applied that short-term holder cohort over the top of it, but really getting your head around MVRV as the unspent side of profit and loss and SOPR as the spent side of profit and loss is really going to help set you up to understanding the incentive versus the actual behavior. And when you then put that cohort analysis over the top, you can really get a nice clean picture of what's going on in the space. So enjoy the market rallying up to 35. Let's see if it actually sticks a landing, and I will see you in the next one. Cheers.